Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis. The topic for today we'll be looking at is private company valuation, and we'll continue from where we left off in lesson 2. Under lesson 3 today we will look at the following: private company valuation. So what we will look at today, we'll look at the definitions of value, there, and then more specifically we'll be looking at the fair market value, and then we'll be looking at other definitions, including fair market value for litigation, fair market value for litigation. There. Then we'll also look at the market value itself, value. And then once we look at the market value, we'll move ahead and look at what we can say the investment value. Then we will move on and look at the intrinsic value of, based under definitions of value, intrinsic value there. And then once we look at that, we will proceed and look at the approaches to private company valuation. Now those are the definitions of value. Then we'll be able to move ahead and look at approaches to private company valuation there. Here we'll specifically look at the income approach, then we will move ahead and look at the market-based approach, then we'll look at the asset approach to private company valuation. Now, once we have looked at these three, they are under the approaches to private company valuation, we'll move ahead and try and look at how we can be able to normalize the earnings for private companies. So, normalized earnings for private companies. So we are just going to see how we are going to adjust the components of the earnings based on cyclicality there. So without further ado, let's begin by looking at the definitions of value. Definitions of value there. Now, the first component right there is the fair market value. Fair market value. Now, the fair market value, we can be able to put it like so and provide a brief description and say that it is the value of an asset based on a hypothetical, number one, a hypothetical willing and able buyer transacting with a willing and able seller. There must be no compulsion to both parties interacting with each other. Number two, we are saying that an arm's length transaction, an arm's length transaction. That the fair market value is the value of an asset based on a hypothetical willing buyer and willing seller, and number two, an arm's length transaction there. So what we mean by an arm's length transaction is that it is supposed to be based on the free will of the buyer and the seller. So you can be able to add over here under the arm's length transaction and say that it is based on a free market. There, it is based on a free market. Now, once we've looked at the definitions of fair market value, let's look at the second component or definition of value: fair market value for liquidation for litigation. Fair market value for litigation. Now, what we can say here, we can say that it is based on the confines of the law. It is the value of an asset based on the written down law, the written down law or statutes. There. So this is based on what is provided in the confines of the law. That is what you're saying is the fair market value for litigation. Now we move ahead over on this side and proceed by looking at the market value itself. So let's look at the market value there. So we say that the market value, that's the third component there that we're looking at, market value. We can say that the market value is the value of an asset. It is the value of an asset. Yeah, saying it is the value of an asset based on real estate appraisal. Based on real estate appraisal, where the purchase is levered, where the purchase is levered. It is also based on the concept of willing buyer and willing seller, meaning that there should not be any form of compulsion among the parties to either buy or sell the asset. Yeah. So that is what you're saying is the market value. Let's look at the investment value. Investment value there. Now the investment value, we can say it is based on the estimates of future cash flows, based on estimates of future cash flows, and also the risk inherent in the asset, as well as the synergy. The component of synergy occurs where we're saying that 1 + 1 should be equal to 5. the combined firm effect will produce an output that is much more than the independent firms, the independent two firms remaining together, as well as synergy there. So we're saying 1 plus 1 should be equals to 5. When these two firms are operating individually, the combined, when they're operating individually, they tend to probably maybe be inefficient, or they may not use their assets to full potential. So what happens is that the combined effect of these two firms coming together will produce an output that is going to be much more than the individual firms operating independently there. So that is what we're saying is the concept of synergy. So having looked at the investment value, now we move on and look at the intrinsic value. Intrinsic value there. Now the intrinsic value is the value on the asset of an asset based on the perceived view by the analyst or by the investor. So we can put it down and say that the intrinsic value is the value of an asset. It is the value of an asset based on the true value of, put true, I can be able to put it in quotes there, true value of the asset, true value of the asset. I'll continue on this other side here. True value of an asset based on mispricings, based on mispricings. So we can say based on mispricings. Based on mispricings. So we are saying if the current market price is greater than the intrinsic value, the current market price is the price that is yielded by the NSE or Nairobi Securities Exchange, and this intrinsic value is the value based on either the dividend discount model, the free cash flow valuation, or even price multiples, including the residual income. That is what we're saying is the intrinsic value. Then you're saying that the security or the asset is overvalued, priced. It's overvalued or overpriced there. So this is the rule of the thumb that you need to, you as an analyst need to understand, is that if the current market price is greater than intrinsic, then you're saying that the asset is overpriced there. Now, having looked at the definitions, the various definitions of value right there, now you can see we have actually covered this component very well, very elaborate about that. Now we move on and look at the approaches to private company valuation. So we have approaches to private company valuation. There. Now we have mentioned that we will look at the income approach, the market-based approach, and the asset-based approach of private company valuation. So let's start off by looking at number 1, income approach. Now, under the income approach, what we need to understand is that the income approach is just the present value of the expected future value of the asset there. So what am I saying? I'm saying that based on the income approach, I'm trying to determine the value of the private company. It is the present value of expected future income that is going to come in. Hence the word income approach. So we can put it down and say it is, or it values the private company. It values the private company based on the present value of expected future income to be received by the private company. There. That is how we can be able to say, in brief, the income approach will work out. Now, we will be able to look much later on in our next lesson how we can be able to use the income approach to value private companies there. Now, having looked at the income approach, let's look at now the market-based approach to valuing private companies. The market-based approach to valuing private companies. Two, we can say, is the market approach. Now, one thing that you need to note under the market approach of private company valuation is that it values an asset based on the comparable sales data. Market-based approach values the firm or private company based on comparable sales data. So we can say it values the private company based on comparable data based on sales as compared to those of other companies. Compared to those of other companies. That is the market-based approach. So we are trying to compare, okay, the price earnings ratio for company X is maybe 2.3 times like that. What about the comparable within the same industry of company X? Maybe it is 3.3 times. So we are saying that as far as X is concerned, it is undervalued because you're saying 2.3 is below 3.3 times, and hence that means that the private company should actually be purchased. It should actually be purchased. Now, moving on, we look at the third approach to private company valuation. The third approach is the asset approach, based approach. There. And here we say it values the private company based on the value of its assets minus the value of its liabilities. So we are simply saying, into brackets, assets minus liabilities provides the asset and provides the value of the private company like that, based on this asset-based approach. The assets minus liabilities provides the value of the private company. Now, having looked at these three approaches to private company valuation, we have looked at the income approach, market-based approach, the asset approach. Let's try and move on and looking at and we look at the normalized earnings for private companies. Now, one key thing that we need to understand as analysts is that normalizing the earnings is trying to adjust the component of earnings for cyclicality. So we're looking at normalized earnings for private companies. Now, normalized earnings we had looked at it when we were looking at market-based valuation, price and enterprise value multiples. And we said what? We said when trying to normalize the earnings, there are two approaches. The first one is average ROE method. And this average ROE method is for public firms, firms which have been listed on the exchange. So we had said we get the average ROE. So if we got year 1, 2, 3, 4, 5, and you've been given the ROEs like that, you've been given X, Y, Z, V, and U. So what we do, we just get the average of all of these. So we get X plus Y plus Z plus V plus U. We all divide by 1, 2, 3, 4, 5. Because you're saying it's 5 periods, we get maybe we get a value A star, an asterisk there. Now this A we multiply by the most recent book value per share. So now we get to estimate the earnings, we said it is A star multiplied by the most recent book value per share, so that we can be able to estimate the earnings component. That is for public firms. For private firms, it is slightly different. I'll be able to shortly explain how different it is. Now that was the first method which we had looked at under the average ROE method. The second method that we looked at is historical average EPS method. Historical average EPS method. Now under the historical average EPS method, what we do, we just get, if you have 1, 2, 3, 4, 5, we have X, Y, Z, V, and U, like that. So what we do, these are the EPSs now. Assume these are the EPSs given, and to estimate the EPS based or to normalize the earnings, you just get X plus Y plus Z plus V plus U. We divide by 5, and the answer we get there like that is the estimate of the EPS. We have normalized the earnings. Trying to adjust for cyclicality, that's what we said we do. Now, these two methods are applicable in for public firms. For private firms, what happens is that we will first of all have to try and identify how say for example characteristics such as the selling, general and administrative expenses are as in relation to the market versus company X. So what am I saying? I'm saying if the selling, general, administrative expenses from over here for the market we are saying is 100,000, like that, and the SG&A, selling, general, administrative expenses for company X that you're trying to determine the value for or of is 130,000. What you need to do as an analyst, you need to make sure that these ones should be normalized to be similar to that of the market. What do? We need to make an adjustment. So we reduce the X's, S, G, and A, selling, general, administrative expenses by 30,000. That's what we say. If, for example, the executive compensation for the market, or the average executive compensation for maybe CEOs in the market, the average is probably maybe 1.5 million there, for example, and we're comparing with that of company X, and we're saying here it is 2.5 million, like that. So the adjustment right over here is to reduce the compensation figure to be similar to that of the market, compensation by 1 million. However, if other characteristics moving down over here, say the market is maybe for maybe a given characteristic over here is maybe 30,000. Let's say lease leases is 30,000, that for the market. And over here for company X is 15,000, like that. So what we're supposed to do as part of this adjustment column right over here is to increase this. Rather, we're trying to make sure that this one is similar to that of the market. So we increase the lease rate or the lease component by 30,000, like that, or by 15,000 rather, 15,000, so that we can be able to ensure it is similar to that of the market. That is what we're saying is how we normalize the earnings for private companies. The best way to explain this is by looking at an example. And I have one example right over here. It reads as follows. Tim is a principal shareholder, CEO, and founder of A company. A reports the following. Number one, Tim's compensation of 2.5 million is included in the firm's selling, general, and administrative expenses. Number two, A leases a warehouse for 100,000 a year from one of its largest suppliers. Number three, A owns a vacant office building with reported SG&A expenses of 150,000 and 25,000 of depreciation expense. Number four, A's capital structure has too little leverage. An analyst determines that the market-based compensation figure for Tim's position is 1 million and that of the office building is not needed for core operations. The market lease rate for the warehouse is 130,000. Based on 1 to 4 above, what adjustments should the analyst make to A's reported income to estimate normalized earnings, assuming the firm will be acquired? So, based on the statements provided in the question from 1 through to 4, we can be able to perform some adjustments so that we can be able to estimate the normalized earnings, or we can be able to get the normalized earnings adjusted for cyclicality or for differences based on the market values. So we are saying in point number 1 that Tim's compensation of 2.5 million is included in the firm's selling, general, and administrative expenses. So we can be able to have over here compensation. So we have over here the market, and here we have for company A, and here we have the adjustment. Remember, we are trying to normalize the earnings. We are trying to ensure that A's, say for example, compensation will be similar to that of the market. So what do? We are saying in point number 1 that Tim's compensation of 2.5 million is included. So here is 2,500,000, like that, has been included in the selling, general, administrative expenses. But what are the market levels as far as compensation is concerned? We're being told down there after point number 4 that an analyst determines that a market-based compensation figure for Tim's position is 1 million. So here we have 1 million, like that, and here we have 2.5 million. We must reduce this so that we can be able to estimate the correct value of normalized earnings. We reduce this by how much? 2.5 minus 1 million, we get 1.5 million. So reduce, the adjustment component here is reduce A's compensation by 1,500,000. And how do we get 1,500,000? We can be able to open the brackets here, say 2.5 minus 1 million, like that. That is the first characteristic. We can be able to put an end to it like that, and we can be able to just try and extend these lines, so that we can be able to create some form of columns. That is compensation. Number 2 says what? A leases a warehouse for 100,000 a year from one of its largest suppliers. So lease that. Now for A, we are saying here it's 100,000, like that. How about for the market? Down there, we're being informed that an analyst determines that a market-based compensation figure for team's position is 1 million and that of the office building is not needed for core operations. The market lease rate for the warehouse is 130,000. So the market is 130,000. So we must ensure that the leases are similar or almost the same as that of the market. So the adjustment right over here we can say is to increase. You can see it is less than the market, so we increase lease component by 30,000. Increase the lease value for A by 30,000. So that you can be able to ensure that it is normalized for market adjustments or movements. Number 3, A owns a vacant office building with reported SG&A expenses or selling general administrative expenses of 150,000 and 25,000 for depreciation expense. So we can say SG&A and then what have we been told? And depreciation. So I'll list them right besides each component there. So we are saying we have the SG&A expenses is 150,000 there, and for the depreciation is 25,000. Like that. What about for A? Rather, I've actually not put them at the correct place. Sorry about that. You are talking about A. We're not talking about the market. So this should be 150,000 and here should be 25,000. Apologies for that. Let me just get the correct position. Yes, we're talking about A. What about the one for the market? For the market, we have been informed nothing as far as the SG&A expenses and the depreciation is concerned. So here it is 0 and here it is 0. So what should we do? To A, reduce SG&A and depreciation by 150,000 and 25,000 respectively. Like that. So that we can be able to normalize the earnings there. Finally, we're told that A's capital structure has too little leverage and we haven't been informed anything about the market levels. If you have a component that is too little in terms of the leverage or the loan component, then we don't need to make any adjustment whatsoever, because you're saying that A has got almost a 0 component of leverage over here. If this is the characteristic of leverage, this is 0, and over here we don't have anything on the market levels, then there is no adjustment that actually needs to be done in that regard. This brings us to the end of this lecture, where we have looked at these components right over here. We've defined the value. We've looked at the approaches to private company valuation. We have moved ahead and looked at how we can be able to normalize the earnings for private companies. We hope that you can be able to join us in our next lesson, where we will build on these concepts which we've looked at here. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.